Hello, everyone. We are so happy that you joined us today for our program. I am Emily Shacklet, Director, Practice Group Leader, and Wealth Advisor at Fairport Wealth, and I present today with my esteemed colleague, Pete DeVito. If you've never heard him present before, you are in for a real treat. Not only is he very smart, very knowledgeable, but he's very funny and has great stories, mostly picking on his children, which I can appreciate because I have children to be picked on as well. Fairport's Wealth, our mission is to inspire families. And today, Pete and I hope to inspire all of you to optimize your wealth, no matter what stage of the wealth cycle you're in. It's never too late. And we ask that you use this information to inspire your families, your friends, your kids that you might also like to pick on, just to be, make bigger and better decisions around their wealth. So with that, we'll get started. We always like to start with a little quote. And when I say little, whoa, this is a heavy quote. Thank you, Benjamin Franklin. In this world, nothing can be said to be certain except death and taxes. Sounds so scary, but interestingly enough, I'm here to tell you that Pete and I make taxes fun. So please stick with us. We are going to find a way to make this interesting and enjoyable. So let's talk about why do we care to optimize our wealth? It's not for the money. We are not trying to optimize money for money's sake. Money isn't the end game. At the end of the day, it's our goals that are the end game. It's our goals that will drive us to make the decisions around our wealth that will get us to where we want to be. So whether it is taking care of your kids or taking a dream trip, renovating that old 1970s bathroom you have, or buying a new vehicle, it's those goals that are going to help us to get us to where we want to be in our wealth journey, and to be making good long-term decisions around our wealth. So as I talked about earlier, there are really just about 4 life cycles or life stages in the wealth journey. And as I look at this, I've passed a lot of these stages, but again, this isn't just about us and maximizing our own personal wealth, but it's about sharing this knowledge with the people around us. So for all of these topics, they'll be of interest to all of us because there's people in our lives that we can help. We're going to talk you through the decisions that you want to make as you are just starting out in your wealth journey. That's our kids, maybe. In some cases, our grandkids. We'll talk you through the decisions that you want to make in those peak earning years. In retirement, and yes, I'm here to tell you that it's never too late. And even if you're in retirement, there's a lot of really great decisions that can be made to optimize wealth. And then in planning your legacy. So with that, I'm going to kick it to Pete to talk about it's never too soon to start saving.
Thank you, Emily. Well, let's get started, which is a nice segue into this next slide. This is a good chart because it demonstrates the power of compounding. It compares 2 investor saving strategies to determine who has earned more at retirement. Investor 1 starts at age 25 and contributes $5,000 a year for 10 years, whereas Investor 2 doesn't start until age 35, but contributes $5,000 a year for 30 years. Now, assuming a hypothetical 8% return, Investor 1 has actually accumulated $175,000 more than Investor 2 at age 65. Despite contributing $100,000 less, all because of starting early and giving your money more time to grow. Now, another way to relate the power of compounding is the rule of 72. You start with 72 and you divide it by a stated interest rate to determine how many years money will double. For example, at 6%, money doubles every 12 years, at 8% every 9 years. If you accumulated $500,000 at age 45, and it grew at 6%, it would double to $1 million at age 57 and $2 million at age 69, all through the power of compounding.
So let's talk a little bit about retirement savings plans. And again, ideal goal is always to maximize your retirement savings plan, but we're talking about those early retirement years when people are starting to save. And that may not be a goal that they can attain at that point in time, is to reach that max. which by the way, right now is $23,000 for anybody under age 50. And then if you're 50 plus, there's a catch up of $7,500. So that's a lot of money and probably a lot for somebody in their early retirement years. But a couple quick comments on that. What I would suggest is if you can't contribute the maximum, try to do your best to at least contribute enough to fully maximize whatever your company's match is. If you can't get there, get as close as you can. The next comment I would make about that is just simply, as you're receiving salary increases each year, hey, money you're not used to getting, right? Then just try to put a little bit of that salary increase, if not all of it, into your retirement plan each year to continue to bump up that percentage you're able to contribute so that at some point in your career, you are able to fully max out your retirement savings. So that's really kind of the point I would make there. The other thing I would bring up here is Roth. Talked a lot about this with clients. We do this often because what do we want in retirement? We want choices. And different types of money is taxed in different ways in retirement. So Roth IRAs taxed differently than traditional. So a lot of people say, should I Roth or should I not Roth? My answer to that would be certainly if you're in the lower tax brackets, put as much as you can into the Roth because it will later be tax free. But if you're in higher tax brackets, don't discount the fact that it may still make sense to use a Roth 401k contribution, particularly if you are finding that you're very heavily weighted in traditional IRA, traditional 401k, traditional 403b savings, and you don't have a lot of Roth, you don't have a lot of taxable, consider doing some Roth contributions so that you can start to balance that out to, again, provide more choices for yourself in retirement. The one other thing I'll mention here is just a term, and you can take it from there and ask questions as you will, mega Roth IRA contributions. Some companies, not all, and probably less companies provide this opportunity. But if your company provides it, you should consider it, particularly if you're throwing a lot of money into your retirement plan and saving over the max. If your company allows for after-tax contributions to your retirement plan and in-plan conversions, you may have the ability to do what's called a mega Roth. So if this is something, again, you're maxing out your retirement plan, want to put more in, your company allows for after-tax contributions and in-plan conversions, ask more questions, talk with your advisor, because this could be a way for you, again, to save more and to save more in a balanced way. So with IRAs, there are definitely some limits to contributing to IRAs, particularly if you're working and you have access to a company plan. So just keep that in mind. But if you meet those requirements and or do not have access to a company plan, it's great to be able to contribute to either a traditional IRA or a Roth IRA. The allowable contributions this year are $7,000 with a 50 plus catch up of $1,000. And again, you aren't necessarily limited on your traditional IRA contributions, but with Roths, if you have access to a plan or if your AGI is over a certain limit, you are limited. So be careful, ask the right questions, talk with your wealth advisor to see if you're eligible to contribute. One little used tool that could be used more often is if you do not have an outside IRA, consider what we call a backdoor Roth contribution, where you contribute to a traditional IRA on an after-tax basis. You do not take a deduction, and then you quickly convert that into a Roth IRA. Since you have cost basis, you didn't take a deduction, you do not pay taxes on the conversion. So this is a way to start again to build up a Roth IRA bucket. But if you already have a large IRA balance, it can create unintended tax consequences. So make sure before you make that decision, you understand the big picture of all the assets that you have out there. Now to you, Pete, for 529 plans.
When we first did this seminar 6 years ago, my oldest son was just starting college. And now 6 years later, he is still in college. But I will say, though, he has become more aware of 529 plans, mostly because his balance is nearly zero. But 529 plans provide a lot of built-in tax advantages. Earnings accumulate tax-free, distributions are tax-free, provided they're used for qualified education expenses like tuition, room and board, books, and even technology. Now, contributions to a 529 plan are deemed taxable gifts, but if the amount is less than the current annual exclusion, there are no gift tax implications. And furthermore, you can front load 5 years of contributions into one single year. The only caveat is you cannot make other gifts to the beneficiary during that 5-year period. Most states in which you are a resident and invest in their plan allow some type of state income tax deduction. Now, some other recent enhancements include you're allowed up to $10,000 each year to cover private school tuition for grades K through 12 and a lifetime withdrawal of $10,000 to repay student loans. And new in 2024, for those overfunded plans, you can now roll over to a Roth IRA, tax and penalty free, up to a lifetime limit of $35,000 for a beneficiary whose plan has been open 15 years. Now, this is still subject to the $7,000 annual IRA contribution limits we just talked about, which means the beneficiary must have that much in earned income each year to be eligible for the rollover.
So let's talk about another wonderful tool for savings. And this tool really is available to you all the way through age 65. So I would say this extends beyond the early savings years. This is the HSA. And I'm going to focus a little bit more here on this left-hand column HSA versus the right-hand column FSA. The real main key differences between the two is when you save in an FSA, you're saving pre-tax, just like you are with an HSA, but you use it or lose it. Each year, you need to make sure that whatever funds you save into the FSA, that it is used within that year. Otherwise, it goes bye-bye. And unfortunately, that happened to me once where I lost some money in my FSA. You don't want to make that mistake more than once. You don't even want to make it once. With an HSA, though, it is one of the few things out there that they call triple tax protected assets. It is because you can contribute to an HSA, either tax-free or if you're contributing after tax dollars, you get a tax deduction. You allow it to grow. You can invest it in anything, including equities, well, mutual funds, and it can grow tax-free. And then when you distribute it, as long as you distribute it for medically related uses that are approved, it is distributed tax-free. So it is a wonderful tool. Now, the key is you have to have what's called a qualified high deductible healthcare plan. You can't do the mental math on that and say, well, my deductible is X, so it must be high deductible. You really have to talk with your plan administrator and understand if that plan meets the particular qualifications of a high deductible plan. And if it does, you can either use a company sponsored HSA if they have one, and that is your ideal state because you get the full tax benefit, or you can go and open your own HSA if your company happens not to provide one for you. And again, this is a really great way to accumulate money. My recommendation is accumulate. Don't use it. If you can avoid it, just keep letting it grow because this is not a use it or lose it plan. You can let this grow and continue all the way into deep retirement and use it for your healthcare expenses when presumably they'll be much higher than they are in your younger years. Let it grow tax-free as long as you can. So that's my biggest recommendation there about the HSAs. So now we're going to move into the peak earning years. So we do an entire presentation around this one particular slide, which is a compensation and benefits presentation that runs the gamut, information that's really interesting to high-level executives that have lots of stock options, all the way to people just starting out in their careers and trying to negotiate. The key is in your peak earning years, you want to make the best possible decisions around your money. So I'll hit on a few just quick hit topics because you certainly don't want to hear that whole hour-long presentation about compensation and benefits. And there's a few little things I can pull out of here that I think really will help. Just first, love to tell little shock and awe stories. So believe it or not, if you advocated for yourself and you were able to negotiate just $5,000 more in base salary when you were age 29, it would result in a 300,000 plus increase in your wealth over the course of your career. That's one pay raise request or one negotiation one time. And that even just assumes 2.5% annual raises and small rates of return. I mean, that's a really powerful, impactful proof that just asking for what you think you deserve, having a conversation, negotiating for yourself can have an absolutely huge impact on your career long term. And I'm here to tell you, I do a lot of speaking around this topic. I did not do this for myself when I was age 29. I did not always advocate for myself, but let's encourage our kids to do that in a respectful way and to make sure that they're asking the right questions and getting what they deserve. I think the other thing I would say here is do not sleep on the non-cash type benefits surrounding your employment. That's the place where I see people either the most happy or the most unhappy when they make a career move and haven't asked all the right questions. So think about things like your company 401k match, your cost of your medical benefits, the club dues or society dues or continuing education credits that you need as in the normal course of your job. Do they reimburse those? Do they help you with those? It can be a huge impact on your overall wealth and on your overall cash flow in a given year. The last story I will share, this is a bit more of a, big executive-based situation, but sharing a story about a really smart, really skilled CFO that I worked with many, many moons ago. And she was making a change from one company to another, and she had a equity grant, we'll call it. It was a restricted stock grant that she had with her old company, and it was about to vest in around 6 months or so. She decided to change companies, brought this up with a new company, advocating and negotiating for herself, and they said, wonderful, we will definitely replace that grant. But they gave her an offer of a grant that had a cliff vest after 3 years. Well, I just simply said, hey, what happens if they don't love you anymore between now and the 3 years? Does that mean you lose this? Is there any way to negotiate that? Oh gosh, I don't know. I don't know that they would do that, but it's worth asking the question. Fast forward, she asked the question, adjustments were made. The company ended up parting ways with her before the 3 years, and she was really happy that she advocated for herself. So these kinds of decisions can have a huge impact, and I think that also suggests we can be emotional about our own situations. So just make sure that you have sounding boards. You have a team of people around you that you can bounce things off of that can say, hey, I think you deserve to ask this question or think about that question. Let other people help you advocate for yourself as well.
Income taxes are also important during your peak earning years, and they're going to start getting a lot of attention soon. Not just because this is an election year, but because the current tax rates are set to expire on December 31st, 2025, and revert to the old 2017 laws unless congressional action is taken. Now, this chart here reflects a 100-year history of income and capital gain taxes. The top line represents ordinary rates, which include items like wages, self-employment income, Social Security, and IRA distributions, while the bottom line represents capital gains, which apply to qualified dividends and investment sales. And as you can see from the chart, we are still near historic lows in tax rates. This next chart is an extension of the previous slide, but looks at the rate changes over the past 25 years. Now, under current tax law, ordinary rates are split into 7 brackets ranging from 10 to 37%, while capital gain rates have 3 brackets at 0, 15, and 20%. And just to complicate things further, The top rates include the Affordable Care Act surtaxes for individuals making over $200,000 and joint filers earning over $250,000. It is actually 0.9% on earned income and 3.8% on dividends and capital gains, which is why you see the actual top ordinary income rate being 37.9%, and the top capital gain and dividend rate ends up being 23.8%. Now, since the Tax Cuts and Jobs Act of 2017, marginal rates on average have dropped about 3%. But the big change was the elimination of personal exemptions and the increase in the standard deduction. Nearly 90% of taxpayers now take the standard deduction. This compares to less than 70% under the old rules. The alternative minimum tax, or AMT, was retained, but the exemption was substantially increased, making it mostly non-existent. I used to say if you asked 10 CPs to explain AMT, you'd get 11 different answers. Nobody could properly explain it, but it affected 80% of taxpayers making between $250,000 and $500,000. It went from hitting over 5 million people to now just 200,000. But if these tax cuts are unwound, it's projected to bring as many as 7 million people back into AMT. Now, there were numerous changes to itemized deductions, but the one that is probably the most notable is the capping of the state, local, and real estate taxes at $10,000. Previously, there was no limit for regular tax purposes, but many of you may not have gotten the full deduction due to AMT. And with the standard deduction increase, the benefits of itemizing have decreased the last few years. But the one item that can still be an effective tax strategy is charitable gifting. Many tax planners advocate a bunching strategy whereby you accelerate charitable donations to be able to itemize in one year and then take the standard deduction in the next. This way, you can best maximize your deduction.
So we talk a lot about diversification, but I think more often we talk about diversification in the context of asset classes and investments. Well, I'm here to tell you, you can actually diversify for taxes too. And it's really what we were talking about earlier when we discussed the reasoning behind why you want to be thoughtful. Traditional IRA savings, Roth IRA savings, taxable savings. You really want choices amongst your assets in how they are taxed, and different types of assets are taxed differently. Pete talked about it a little earlier on the slide he shared, where if you have capital gain assets, i.e. long-term held investments in your taxable portfolio, those are typically taxed at 15 or 20%. Whereas if you have ordinary income, things like your wages, things like your Social Security and your retirement distributions, these are taxed at your marginal tax bracket rates, which at the moment could be anything all the way up to 37%, plus, factoring in the Medicare tax that Pete was talking about earlier. So that's why you want to be able to diversify, because you've got different tax treatments of these different assets. And then, of course, the holy grail of the buckets, those tax-free buckets. So in an ideal world, as you are building up towards retirement, you're starting early, thinking about how you make sure you do that tax diversification. And of course, there's other things to consider in here, such as if you've got heavy positions of company stock or restricted shares, if you've got too many of your assets in traditional retirement plans, and oh, for goodness sake, you decide to retire earlier, before that age 59 and a half, then you may have penalties, or you may be forced to make a decision to take distributions in a more streamlined and more consistent way. So again, just be thoughtful about the way you save so that you're setting yourself up for whatever that retirement goal is that you established as you were planning. So taking us now into the retirement discussions. So creating a withdrawal strategy. Really, again, you don't want to start this when you retire. You don't want to be like, oh, time to retire, I'm going to create my withdrawal strategy. You need to be thinking about this as you're saving so that you can set yourself up for good decision making. And then again, quite a few years, I would argue 5 plus years before you retire. Because as we've all seen, just here in the last couple of weeks, markets get volatile. Things can get very bumpy. And I'm here to tell you that the wealthiest, smartest, strongest people, as they're going into retirement, it gets very scary. And particularly if you're going into retirement in a time when the market is volatile and bumping around, and all of a sudden you have to get used to living off of your assets as opposed to living off the paycheck you're getting, that's a very scary undertaking. So if you have considered your withdrawal strategy and built it properly and made sure to asset allocate in a way to support what you need distributed, you can take a bigger, deep sigh of relief. And even if you're nervous, you call your wealth advisor and they say, hey, we've been working on this for a while. We knew you were retiring. This is nothing new. And we've got this set up in a way that's going to support your needs, even if we see some bumps along the way. So take a deep breath. You've made good decisions. You want to be able to do that. And that's why you need to start thinking about these things early and thinking about them broadly. So moving on to consolidating retirement accounts.
So the biggest change in the retirement world was the Secure Act. It removed age restrictions on IRA contributions, and it also increased the required minimum distribution, or RMD, age from 70.5 to 72. RMDs are annual amounts that must come out of retirement accounts based on an actuary life expectancy factor. Now, the Secure Act 2.0 that was just passed last year further increased this RMD age from 72 to 73, and then again to 75 for anybody born in 1960 or later. And it also greatly affected inherited IRAs starting in 2020. Now, typically when a spouse dies, the surviving spouse can roll over the IRA as if it was their own and take it out over their life expectancy. That did not change. However, non-spouses like children who inherit IRAs are now required to withdraw the account within 10 years. This is a big deal because under the old rules, a child who inherited an IRA at age 40, say, would have been able to stretch that IRA out over a much longer lifespan and pay less in taxes each year. And just last month, the IRS passed final regulations that require non-spouse beneficiaries of inherited IRAs to take annual distributions if the account owner had died after beginning their RMD. So basically what it means is that once RMDs have started, they cannot be turned off. These new regulations don't go in effect until 2025, so no corrective action needs to be taken if you did not distribute any RMDs from 2020 to 2024. Now, converting to a Roth IRA can be one way to combat an inherited IRA tax burden to your beneficiaries. This popular strategy, as Emily detailed, is to pay tax now so you don't have to pay tax later. Converting even a portion to stay in the same tax bracket can result in significant savings over time, especially if rates go up in the future. A qualified charitable IRA distribution is another effective strategy, especially if you do not need the income and you're charitably inclined. The requirements are that you must be at least 70.5 and the amount is less than $105,000 for 2024. By donating your RMD, you reduce your taxable income, which could also potentially mean lower Medicare B and D premiums. And if you're a resident of a state like Ohio that provides no income tax break for charitable contributions, that can be up to another 5% in potential tax savings.
All right, so let's talk a little bit about Social Security. I know a lot of people worry about Social Security. They say, wow, is it even going to be around anymore when it comes time for me to collect? Should I collect now as soon as I possibly can in order to make sure I get my full benefit? Well, yeah, there's definitely a lot of discussion around Social Security, and I think certain things are going to have to change and it's going to have to be discussed. But that being said, most of the times when I'm doing calculations around Social Security, in an ideal world, you're not looking to collect at your earliest possible age, which is age 62, because you are taking a significant haircut on your benefits, it's a reduction of as much as 30% of your benefits to collect at age 62. If you look at it right now, for most people, full retirement age is currently age 67, and waiting until full retirement age gives you your 100% benefit. For each year you go past your full retirement age, up to age 70, you can actually tack on an additional 8%. So if you are in those retirement years, you don't need the Social Security and you're able to live off of other assets, most of the calculations we do show that you're actually going to be better off if you wait as long as you live into call your mid to later 70s, waiting to collect until 67 or 70. Certainly, if you're going to collect earlier, you need to factor in your other earned income, because earned income for Social Security can impact your benefits if you're under full retirement age, and it can actually take an additional haircut beyond the one you already took for collecting early because you've earned too much income. So just be mindful as you make those decisions, and again, ask questions and talk with your advisors, because it could really make a lot of sense to wait. There used to be a lot of fussing around that you could do and different claiming strategies. It's pretty neat and tidy these days. They've closed a lot of those loopholes. I got to use it once with a client before they went away. But there are some spousal claiming strategies that you can consider. So again, ask questions. This is something you want to start thinking about a couple years before you turn Social Security age, so that you can run analyses and make the best decision for you, your expected life expectancy, your family history, the family around you, and what goals you're trying to accomplish. So next, we will move on to planning your legacy.
So not only did the individual tax landscape change in 2018, but so did the estate tax world. The law doubled the estate exemption from $5.5 million per person to $11.2 million, and it continues to be indexed each year for inflation. In 2024, the estate exemption is $13.61 million per person. So this means a joint couple would need to have assets greater than $27 million in order to have an estate tax liability. Now, some other key features have remained the same. Assets continue to get stepped up at their fair market value at the decedent's death. There was a concern that if the estate exemption was increased this much, these step-up rules would go away. And for beneficiaries, this is huge because you can sell inherited property, then you have essentially no capital gains if it's stepped up to fair market value. Portability was also retained, which means the surviving spouse can utilize the unused exemption of the deceased spouse. This simplifies estate tax planning somewhat, so you don't have to worry as much about titling assets in each other's names to avoid wasting any unified credit. But the one big takeaway we'll say is that nothing is permanent anymore. The estate tax laws will also expire at the end of 2025 and revert to the old 2017 rules unless Congress acts. And with the ballooning budget deficit and uncertain political environment, there's the possibility these tax cuts may not get extended past 2025.
So should you gift money to your family? They're all saying yes, you should. And you know, it's a fun way to watch your family enjoy the money that you're giving them during your life, as opposed to waiting until you pass it along with your estate. And there's lots of ways to do it. There is the annual gifting exclusion, which has continued to go up. It is now $18,000 can be given per person per year without any requirement to use up exemption. So that's a nice hefty number. And if you are married, you can elect to split gifts with your spouse. So you can give an individual $36,000 total, 18 to each of you. And if you elect gift splitting, you file a gift tax return to report that. So that's one way to just get money to the next generation that you know you won't need for your expenses, and do it in a simple way without using up any of your exemption, and watch them enjoy it. So, you know, what could be better than that? Another thing, you may say, interfamily loans, who wants a loan? Interest rates have gone up, it's painful. Well, you know, interestingly enough, as much as interest rates have gone up, we're still seeing a lot of intra-family borrowing because the borrowing rates are much more reasonable, for example, than if someone had to go out and borrow money to go to med school or borrow for a home loan. When you do intra-family borrowing, you have to use a minimum rate. You can use more than this, but you have to use a minimum rate, which they call the AFR rate. And that ensures that if you use that rate or above, that the IRS won't come back and say, that wasn't really that wasn't really a loan. That was a gift because you didn't use a reasonable interest rate. Well, so Pete and I did this program a couple years ago, and the AFR rates were for short term 2.37, for midterm 2.98, and for long term borrowing 3.22. Well, of course, interest rates have definitely gone up, but in an interesting sort of way, because as we probably know, listening to John with his investment discussions, the yield curve's a little weird right now. And so actually right now, it's cheaper to borrow on a long-term basis with the AFR than it is on a short-term basis. The short-term AFR is currently 4.95%, and that's for any borrowing 3 years or less. The midterm AFR, so if you're borrowing for 3 to 9 years, that's 4.34. So that's lower than the short-term rate. And then if you're borrowing on a long-term basis, so that's anything, beyond the 9 years, borrow for 30, 40 years, that's 4.52% currently for long-term borrowing. So again, although the rates have gone up from when we did this a couple years ago, they are still much lower than if you were to go out and get a school loan, 6, 8+%, or a home loan or a home equity loan, which again, I'm seeing home equity loans still in the 6 and 7% ranges. Haven't looked at mortgage rates lately, but I think they're still a little bit on the higher end. So if you have excess funds and you have a family member who wants to go out and buy a home, you can help them with intra-family lending. And this is a way to add to your legacy, help the next generation, watch them enjoy it. These other two items, they're a little bit more on the complex side. And again, not to say we don't use these all the time. Spousal lifetime access trusts or SLATs, GRATs, CUPERTs, and ILETs. But again, we could do a whole program on these, so I'm not going to dig too deeply. But if you either now or as you worry about the estate tax exemption sunsetting back, think you might be in a taxable estate situation, these are the types of tools, these and others, that you can use to start to whittle back that taxable estate, and working with your estate planning attorney and your wealth advisor to make the best decisions around how to capture these exemptions before they potentially revert back.
Gifting appreciated stock is an effective charitable strategy that's often overlooked. Some rules apply depending on how long you've held the stock. If it's been owned less than a year, the deduction's limited to the cost basis. Stock held over a year can be deducted at its current fair market value. Now, deduction is also limited to 30% of your adjusted gross income, or AGI. So if you make $100,000 and you want to donate $40,000 of appreciated stock, only $30,000 would be able to be deducted in the current year, but the $10,000 excess could be carried forward for the next 5 years to be utilized. Now, if the stock has lost value, it's better to sell it first and give the cash to the charity. You'll still be able to deduct your charitable donation if you itemize, but you'll also be able to take a capital loss on the sale. And gifting appreciated stock provides a beneficial dual tax impact. What I mean by that is an example. Assume an individual is in the highest 37% marginal tax bracket and donates $10,000 of stock that was purchased for $5,000. Donating rather than selling would result in a tax savings of $3,700 on the charitable tax deduction, plus another $1,000 on the 20% capital gains tax you avoided on the gain. So in summary, you've gotten almost as much back in tax savings as what you originally paid for the stock. And it's a win-win for both you and the charity because they can immediately sell the position for cash with no tax consequences.
So tagging on to what Pete was just talking about with charitable giving, And you heard Pete talk a little bit earlier about bunching of deductions. A great tool for doing this is the donor advised fund. Many institutions provide the opportunity to contribute to donor advised fund. You can open one up at a Schwab, you can open one up at Fidelity. Your local foundations, such as the Cleveland Foundation or the Akron Community Foundation, you can open up an account, you can name it, the Emily Shacklet Family Fund, and you can contribute to the fund. I would say contribute that highly appreciated stock Pete was talking about to get the double whammy of benefit. And as you are contributing, you are able to take the tax deduction. So let's take a story, for example. You are entering into retirement and getting a couple of big payouts. You have a non-qualified plan that's paying out. And by the way, those non-qualified plans are fully taxable when distributed. They're not like a traditional 401k or IRA. And so you're having a big old tax year. Well, what can I do? I need to save some money. I can't believe that tax bill that I'm about to have. What we will often do is we will pre-fund or heavily fund a donor advised fund in a high income year and contribute that highly appreciated stock. Maybe in a let's just say for argument's sake, you give $20,000 a year to charities. Let's front load that and do $100,000 all in one year because you're having a big income year. You put the money into the donor advised fund, it immediately sells the highly appreciated stock and reinvests in a portfolio of your choosing. And then you allow that money to grow, and it grows tax-free because it's a charitable account. And then you're able to give both the original contribution and the earnings to the charities. And by the way, you benefited from the tax deduction in a very high income year going into retirement. And lo and behold, you've done such good retirement planning that you aren't going to be in a high tax bracket in your retirement years because you've got various money in all the buckets and you're able to balance out your adjusted gross income and keep it, reasonable. So I think that there's wonderful ways to use donor advised funds to set yourself up for the future. Because by the way, you probably would continue to contribute to your favorite charities, or at least I hope you would. And now you're contributing out of your family fund as opposed to out of your fixed retirement income, so to speak. So lots of great reasons to use this. Of course, some folks opt to use things like CRATs or CLATs or family foundations. They're all a little bit more complicated. Not to say they're not worth considering or doing, but if you want a simpler route where you don't have to involve a lot of extra tax returns and attorneys and things of that nature to start, a donor advised fund is a great place to start. So that is all of what Pete and I have for you today. We hope that you learned a few things, talking about how to optimize wealth at every life stage. We think we had some tricks up our sleeves for each of the stages. At the end of the day, making good decisions all throughout the life cycle can really add up, but it's never too late to start. And your wealth advisor will guide you. It's always helpful to have a team of people that are objective, know you well, understand your goals, know your family, and can help you through some of these decisions, which can be pretty complicated and emotional. So thanks for listening today, and we hope you took a few important things away.
Thank you all.